Hello everyone, my name is Farhan. Today here we have another question for depreciation, and this is taken from a past exam, which is 2022 paper 1. So let's go through the question step by step. Nita runs a business operating fitness clubs with a financial year ending on 30 June, and we're required to define depreciation. Now, what is depreciation? Depreciation is an expense, which means that this is the reduction in the value of a non-current asset over its useful life. In other words, you could also say that depreciation is an expense which is the allocation of the cost of the non-current asset over its useful life. Now, what do we understand when we say that depreciation is an expense which refers to the allocation of the cost? You see, when we buy a non-current asset, we have economic benefits that comes with the purchase of that non-current asset. For example, you could buy a motor vehicle if you run a delivery business, and the economic benefit that you get to consume from the motor vehicle is the car delivery services that you could do for your customers, right? So as you consume this economic benefit, the car goes through obsolescence, wear and tear, which is also what we refer to as depreciation, because you have used the capacity or the economic benefit that comes with the utilization of this asset. And as we consume this economic benefit, we also generate more revenue for the business. So just to simplify, I thought you would need an extra idea on what depreciation really means, but just to simplify, if you write that depreciation is the consumption of economic benefits and the cost of the non-current asset allocated over its useful life, you should get full marks. All right, so the next question is to state two accounting theories which are applied by a business when charging depreciation expense. Now, we understand that depreciation is an expense, and the first accounting theory that comes into our mind is the matching theory. The matching theory simply states that profit is calculated by taking all the revenues that we have earned, right, minus all the expenses that we have incurred. So when we say all the expenses, it could be the staff wages and salaries, it could be the rent expenses, general expenses, water expenses, insurance expense, interest expense. So we don't also want to forget depreciation, because depreciation expense is a non-cash expense. So this, as we have discussed earlier, refers to the allocation of the cost over its useful cost of the asset over its useful life. So this expense we don't want to forget. We want to include this cost that we have consumed from the asset as part of a total expense calculation. So that is why we use the matching theory, which states that when you calculate profit, you must include all the revenues that you have earned and also subtract all the expenses that you have incurred, which also includes depreciation. All right. The next theory or concept that we can look into is the prudence concept. Now, the prudence concept simply states that assets and profits are not to be overstated, and liabilities and expenses are not to be understated. So you do not want to forget depreciation, because depreciation is an expense as we understand. So you do not want to understate your expenses, because if you understate your expenses, what happens is you incorrectly overstate your profits, and you also incorrectly overstate your assets when you find the net book value when preparing the balance sheet. So you must ensure that the depreciation is always accounted for based on the consumption of economic benefits and the allocation of the cost over the useful life of the asset. So the prudence theory, as we can simplify, states that we do not overstate assets and profits, and we also ensure that liabilities and expenses are not understated. Okay? All right, so let's move to the calculation section for this question. So Nita's business purchased gym equipment on 1 July 2020, costing $250,000. I believe you can see the question on the left-hand side of your screen. So on 1 July 2020, Nita's business purchased gym equipment for $250,000. The business depreciates equipment using the reducing balance method of depreciation at 20% per annum. We are required to calculate the depreciation expense on the gym equipment for each of the 2 years ending 30 June 2021 and 30 June 2022. All right, so let's start with the financial year ending 30 June 2021. So on 30 June 2021, we know that the original cost of the asset is $250,000, the price that we paid to buy this asset on the purchase date, which is 1 July 2020. So from 1 July 2020 until 30 June 2021, we have one entire financial year that has passed. So if I want to find the depreciation in the first year of usage for a non-current asset under the reducing balance method, we just simply take the percentage that we're given and multiply it with the cost. The percentage that we're provided is 20, and the cost that we know is $250,000. So altogether, the depreciation in the first year using the reducing balance method is $50,000. Depreciation expense for the year ended 30 June 2021 for the gym equipment is $50,000. All right. But let's move to the next financial year, which is 30 June 2022. Now, when you're using the reducing balance method, if you move from year 1 to year 2, you must ensure that you calculate the net book value, because under the reducing balance method, in the first year, we multiply the percentage on the cost, but when we go to the second year, we multiply the percentage on the net book value. All right. So how do we find the net book value? We simply take the original cost and subtract the total or accumulated depreciation. The cost is $250,000 and the accumulated depreciation is $50,000. All right. This $50,000 is what we had calculated at the end of the first year of usage ending 30 June 2021. Okay. So altogether, the net book value to begin the financial year for 30 June 2022 is $200,000. Once we have found the net book value, then you can find the depreciation, which is simply multiplying the percentage of 20 on the net book value. And then you get $40,000 as the depreciation for the year ended 30 June 2022. Make sense? All right, so let's move to the next question. All right. So Nita's bookkeeper has incorrectly calculated the depreciation expense for the year ended 30 June 2022. She has used the straight line method based on a depreciation rate of 20% per annum, assuming no scrap value. So no scrap value here simply means that this machine is worthless at the end of its useful life. Like you can't sell this machine and get any cash in return. You might have to throw this machine. So the requirement is to analyze the effect of this error on the profit for the year ended 30 June 2022. So we understand that we are supposed to use the reducing balance method, but the bookkeeper mistakenly used the straight line method. Okay, and we want to find the effect of this mistake on the profit for the year ended 30 June 2022. All right, so and recall that the equipment was purchased on 1 July 2020, and the mistake was done for 30 June 2022. So from 1 July 2020 until 30 June 2021, we have year 1, and then from 1 July 2021 until 30 June 2022, we have got year 2. So 2 years since the date of purchase, all right? So let's calculate the depreciation using the straight line method for the year ended 30 June 2022. So under the straight line method, we always apply a linear depreciation every year, which is to simply multiply the percentage that we're given on the original cost. So we're multiplying the percentage on the original cost, which is 20% multiplied by $250,000, which is the original cost we paid to buy this equipment on the 1st of July 2020. So this gives us a depreciation using the straight line method of $50,000 for the year ended 30 June 2022. All right. Now, what's the effect on the profit for this mistake? So we understand that under the reducing balance method, the depreciation in year 2 ending 30 June 2022 was $40,000, which was calculated by multiplying the given percentage of 20 on the net book value of $200,000, right? But for the straight line method, where we apply a linear depreciation every year, we found it by multiplying 20% on $250,000. So as you can see, under the reducing balance method, the depreciation is $40,000, but under the straight line method, it's 50,000. So obviously we understand that the expenses have been overstated by $10,000. Okay? So when expenses are overstated, what do you think is going to happen to the profit? It's going to go down because expense refers to the operational expenditure for the business. And how do we find the net profit? We subtract all the expenses from the gross profit. So if we are overstating our expenses by $10,000, then definitely your profit has to be understated by $10,000. Okay? So that's the effect on the profit for the year ended 30 June 2022. All right? And the next part is asking you to analyze the effect of this error on the net book value of the gym equipment at 30 June 2022. All right, so the net book value at any given point in time, regardless of whatever depreciation method you're using, is calculated as the original cost minus the accumulated depreciation. What do we understand by the accumulated depreciation? Accumulated depreciation refers to all the depreciation expense that we have for every year of usage for the asset since the day of purchase. Okay? Now, net book value using the straight line method. We start with the original cost of 250,000, then we subtract 50,000, which is the depreciation we would have got in year one, by multiplying 20% on the cost of 250. And then again, we would have got the same depreciation in year two, which is 30 June 2022. And we would simply find this 20% multiplied on 250. So we have a net book value of $150,000 using the straight line method. When we use the reducing balance method and want to find the net book value, as we had done in part C a while ago, so we started with the original cost of $250 and subtracted $50,000, which is the year one depreciation we calculated under the reducing balance method, followed by another subtraction of $40,000, which was calculated by multiplying 20% on the net book value of $200,000, which is the clear difference between the reducing balance method and the straight line method, right? So using the reducing balance method, your net book value, comes out to be $160,000, okay? So under the straight line method, net book value is 150. Under the reducing balance method, net book value is 160. So we can say that the net book value has been understated by $10,000 because, as we know, the bookkeeper used the straight line method, right? So the net book value has been understated by $10,000, and it has been done because of the overstatement in accumulated depreciation, as we understand, because using the straight line method for the year ending 30 June 2022, the depreciation was $50,000 when the original or the correct depreciation would have been calculated under the reducing balance method at $40,000. So because of this overstatement in accumulated depreciation, we ended up understating our net book value by $10,000. Okay, that's all for today's lesson.